Well, that's right. But I think we've got a lot of cues today, and we have William Lee, who joins us on the show, Chief Economist and Executive Director at Milken Institute, who joins us on the show. Hi, William. Good morning. Thanks a lot for joining in. Well, for us, the big cue that we're looking at is that there is peace for the time being at the border, which is good for economies, good for humanity, and good for peace as well. Tell us, how do you read this, and where would India feature? In your scheme of things, when you're looking at global equity markets, where does India come in?
Well, from this side of the ocean, I have to say I am breathing a huge sigh of relief when I see two nuclear powers on the brink of smashing themselves to death, suddenly calling it off, and some sanity coming back into the picture is a great news. Because the one thing I don't want to see, and no one wants to see, is the India-Pakistan conflict be another test case like Spain was in the 1930s, experiments for different weapon systems and the proxies for the large superpowers like China, Russia, and the United States and Western Europe. And the fact that the huge amount of violence has suddenly come to a stop, I think, is a great sign that sanity is coming back into the market, and a huge sigh of relief. So of all the geopolitical tensions I can think of, this one, because we have two huge nuclear powers involved, is, to me, one of the most dangerous.
Absolutely. William, there's, of course, the hot war here, and there is cessation of the hot war for now, although absolutely clear signal from India that any further terrorist attack will be treated as an act of war. So that's a changed doctrine, which I think India has put out very, very clearly. The other one is not a hot war, but not a cold war either, the trade war, US-China, William. I was saying this earlier with our earlier guests, that it's classic Trump. Announce a deal after 2 days of initial talks. I mean, to call it a deal, you got to. It's I don't know what to make of it. But your thoughts, Sir William?
Well, I agree with you that this over-exaggerating results is something that I would caution everyone from doing, and markets are typically overreacting to everything. I think what we have, as we had with the UK, is a framework for talks and an example of what President Trump means by be a partner with the US and not a competitor. If you're a partner with the US, you benefit from a lot of things, lower tariffs, and benefit from if you invest in the United States and produce here, you get a huge number of exemptions. I think President Trump made it very clear that the U.S. and UK, with the UK being one of the largest net investors in the United States, they are one example of where the partnership has benefited both sides. We have tariff-exempt trade for jet engines and Boeing aircraft going both ways, and I think that is an example of a template where a friendship can lead to benefits for all. Whereas China, we have actually good news, not just from President Trump, but from the Chinese as well. And we have both sides saying we've got good news to announce on Monday. I think there are some high expectations that not only is there a good framework, but a reliable framework might be put in place. We already had deals in the first Trump administration with China. We saw many of the aspects of that deal fall apart and the framework not hold. I'm hoping that this time, because both sides are so optimistic about what they are about to announce on Monday, we're going to have a strong framework where China will no longer be as much of a competitor and will actually start to invest in the United States, perhaps. What they will choose to import into the United States will be more limited. And let's not forget that China, 3% of China's GDP comes into the United States. Because we've shut down all those imports, that's going from a 5% growth to a 2% growth, right? Or 4% growth to a 1% growth. So China really will hurt if they were to lose access to the U.S. market completely. And I think President Trump realizes that and says, look, if you really just want to be a competitor with us and start importing your production from outside the United States into the United States, you're going to have to pay for the privilege of selling here.
All right. William, well, we had discussed this the last time as well, that China is the big elephant in the room, and that needs to be addressed. It appears that's happening. From an India market perspective, we'll be keeping an eye out on developments on that front. But also, what about the dollar index trajectory? We had discussed in the past, earlier this year, that you were working with more strength in the US dollar. And then, in fact, you said maybe, in fact, it could cool off from here on. It hit that high of around 110, breached the 100 mark, and now it's holding in that vicinity. That's important for us because of the FI flows. Tell us, where do you see the dollar index headed?
The dollar index, I think, is still a proxy for whether or not it's a good deal to invest in the United States. And even though it's come off of its historically high level of the last several months, it is well above where it was the last 4 or 5 years. And I think for India, it's an example where we have bilateral flows that are important for both sides. India to diversify its own domestic portfolio and investors to diversify and get away from home bias. The United States, it would be a great place to invest because that's where technological progress is being made, and that's where innovations are being made, and complementary investments, technological progress, rather, complementary progress to what you see in India. So I think the story for India investors is that they should continue to consider U.S. because we are a location of safe investments and complementary investments to what you have in India.
William, great conversation as always and good perspective. Thank you very much for joining us with all of that as we continue to track some of these global developments.